Well, this is the special programming around the economic survey. FM has tabled the economic survey. The key takeaways clearly it says that the Indian economy is on a strong footing and a strong wicket right now, and investor interest from overseas also is holding up well as far as FDI flows are concerned. It says that no shocks may actually happen in the economy. No structural forces have influenced factors right now, and the growth actually is being pegged at 6.5 to 7%. So that is the key highlights, employment generation and many other important points coming in. But let's take the discussion forward with Abheek Barua, Chief Economist of HDFC Group, who's now joining us. Abheek, good afternoon. Thank you so much for joining us. One line
Sure, my pleasure.
Catches my attention is that, the economic survey says that the market expectations of the growth are actually on the higher side than what the projection throws. What do you make of it? I mean, in the last 2 months, several agencies have actually upped India economic forecast, and our readings have also been higher than what the actual readings have been higher than what the street has been estimating. Then why this comment is occurring over here?
I'm honestly a little surprised, but I think it is prudent for anyone who is planning ahead to provide a conservative estimate of things like growth or revenue collections, and that is, if you look at the budgets, that has underpinned most of the budgets of the previous government with the same sort of dispensation in place. So I think providing conservative estimates is sort of a hallmark of budget making and economic planning or strategizing of the BJP and now the NDA government. So I don't see it as that surprising, although I think a rider to this, which is I think it mentioned in the economic survey, is that there are risks on both sides. I would think that the risks to the upside are a little more than the risks to the downside. Having said that, I mean, from what I can see from your ticker, there are a number of headwinds that they are talking about, possibly climate change leading to a crisis again going forward, geopolitical risks, etc. We must remember that this is a particularly difficult year, politically, especially with the U.S. elections coming up and the uncertainty around it. So, in a sense, I think it is one should be lauded for providing a conservative rather than an aggressive estimate. And you can actually sort of perform better than your estimates, which also gives you a level of comfort as the year pans out.
Very fair point. I mean, I'm not taking away the fact. In fact, prudence and conservatism has been the hallmark of this economic framework which we have right now. Also, I want to go about scratch that point of risks. Because this growth 6.5, 7 at a rising base is also coming in the backdrop of a lot of global challenges, and those things which are dragging us down. Despite of that, if we are forecasting this kind of a growth, perhaps it's a very good one. How potent do these risks look to you? Climate change, geopolitical issues, can it weigh us down?
Look, I mean, in a number of ways, it has already begun to weigh us down. Just look at agriculture, for example. It's no longer, earlier we used to talk about whether the monsoons were normal or below normal or whatever. Now it's more about extreme weather events that is sort of influencing Indian agriculture, Indian food production, and so forth. So if you have a climate-related shock, and this could happen in the next couple of months, which completely upends the agricultural growth momentum, then we have a problem. So I think these are legitimate risks. These are not sort of abstract risks that might play out at some point. Geopolitical tensions are intense, and it's all over the place. Of course, the Middle East, the problems around Gaza, which are now kind of spreading across the region to Yemen and so forth. Then, geopolitical risk in terms of a change in the U.S. administration and the possibility of, say, across the board tariffs. Now, these are real risks that have to be reckoned with. So, in highlighting these, I think, again, going back to the issue of prudence and conservatism, I think the chief economic advisor has done an excellent job in saying that, look, I mean, you can't take anything for granted. You have to be prepared for these things, and these are not in some sort of abstract, intangible domain. They are very much, we are sort of living with these things.
In fact, Kanika Pasricha is also joining us now, Chief Economic Advisor, Union Bank of India. Kanika, welcome on the show. Kanika, I'd like to discuss a point mentioned in the economic survey on capital formation. It says that after 3 very good strong years of capital formation, private capital formation, I beg your pardon, particularly, there are signs to be slightly cautious. Now, this is one area which everybody is looking out for in anticipation, how policy making is likely to kickstart private capital formation. Up till now, the front loading of capex has been from the PSU side. Do you see some policy changes to come by which could trigger private capital formation as well?
No, thanks. Thanks for having me on the show. See, 2 points. Till now, when we speak to investors, private capex in our view is mostly government-led, because the government capex, especially from the centre's perspective, they've nearly doubled the amount. So it was around 1.5, 1.7% of GDP pre-COVID. It's around 3.4% of GDP as given in the interim budget. And sectors which are being targeted by the government, that's infrastructure, renewables, EVs, within PLI sectors like electronics as well. That is what is witnessing private capex recovery. And it's not a broad-based private capex recovery. So 2 things to watch out for in this budget. With the degrees of freedom created by the RBI dividend and higher tax buoyancy, which in our view, the number will be anywhere between 1.6 to 1.8 lakh crores. The delta they use for boosting, again, another round of central government capex after that 11.11 lakh crores number provided in the budget to further crowd in private capex. That's one. Second, while capacity utilization for the manufacturing sector is at 75%, but consumption demand boost can be another facilitator for private capex, for a broad-based private capex recovery. So any measures to boost consumption demand to further raise capacity utilization and help support private capex will be closely watched out for in this budget, where we are looking at some transfers, maybe on the rural side, farm side, or income tax cuts. That's another area to watch out for tomorrow. Third, another just last point to add over here is this government, by consistently focusing on fiscal consolidation, is somewhere trying to focus on cost of capital. That's another factor that can support private capex recovery. And we see fiscal deficit with the kind of fiscal space created to be reduced further to 4.9% in the budget tomorrow for FY25 from 5.1% previously. Thanks.